Hello and welcome to our second episode of Get It Now with CashTalk Credit Repair Services Limited. To those of you listening in from YouTube or maybe Facebook, we are happy that you have joined us and we look forward to a very lively and always informative discussion. During this live stream, we will delve into issues surrounding personal debt management, empowering individuals to take charge of their finances and to help them to be able to achieve financial independence. I'm your host, Roel Rollox, financial advisor and business coach. This program is brought to you by CashTalk Credit Repair Services Limited, a pioneer locally and within the region in the field of personal credit repair. During this live stream, we will delve into issues surrounding debt and credit. A little confusing sometimes? Well, if you're like me, you may have asked yourself, what's the difference? These words evoke both positive and negative emotions. Most importantly, do we really need them? Can we do without them? So, do you need greater understanding about debt and credit? Well, let's get it now with Cash Talk Credit Repair. Great, great. Good to be back. And if you're joining us, you're joining Get It Now with Cash Talk Credit Repair Services. And with us today is Mr. Richard Rollox. If the name sounds familiar, well, yes, he's my brother, a former investment manager at Republic Funds Barbados Incorporated. Mr. Rollox is a finance executive with over 15 years in the financial services sector. Richard goes beyond typical financing methods and investment planning and advice to help clients understand their risk tolerance, explore a range of options available to them, and select and implement innovative strategies to meet their financing or investment goals. Good evening, Richard, and welcome.
Hi, good evening, Roll. How are you going? Good afternoon,
Good to
everyone.
have you, man. Good to have you. Good to have you. So we have a short time, so we know we have to jump right into it. But of course, it's always good to connect.
Right.
And one of the important things for those listening in, whether you're on YouTube or you're on Facebook, and of course, remember you can put your comments in the comment section. If we do have time, we will relate to Richard so he can address any burning issues. We know this credit and debit thing could be very confusing. But before we get into that, could you share a little bit about yourself and why you are passionate about helping persons master this area of banking and finance?
Well, I think finance is fundamental to our existence. And first and foremost, let me say that I'm very happy to be here. So I want to thank you for inviting me on. Um, Finance, especially in the Caribbean, growing up, you would see people that often end up into very difficult circumstances financially. And sometimes you wonder, how could you as a young person navigate or do differently? The thing is, it doesn't come, um, you know, firsthand. Like some people might just have a natural inclination to finance or just the ability to manage their finances. But for the most part, like everything else, is something that requires skill, and it requires education. It requires you to seek out education and find the right fit and the right tools and method to achieve your financial goals. So for me personally, finance was something that, ironically, I never really did want to get into as a field. However, I realized that it was a field that I always shy away from, and I always desired to make it a strength of mine. So hence, I went into finance, and here I am. I say 15 years later.
Oh, great. So it's important to have persons who can identify, and in your experience, Richard, do you find that persons coming to the bank are generally informed, are they really aware, Do they do the research? What has been your experience?
Well, the thing is, from my experience, you know, in finance, we will put, I guess, people into different categories. There's sophisticated investors, and then there's the ordinary man in the street. And the sophisticated investors or sophisticated borrowers would usually be like a small group of people, probably like between 1 to 5%, you know, of the population. And what that means is that everyone else kind of figuring it out as they go along. I think it's very important to understand finance, not just for you, but for your family, for the success of your family, for your growth of your business. And at the end of the day, it helps you to unlock doors towards financial independence.
Yes, so important to understand that. So let's jump right in, right, Richard? So we talk about debt and we talk about credit. What's the difference?
Well, yeah, in most circles, you will find that the word debt and the word credit, it is used interchangeably, and then sometimes you will find that the word debt, it sounds like a bad thing. You know, growing up, when you hear debt, it sounds like we use it synonymous to being broke, right? So people say, no, I don't want any
Yes.
debt. And that is, I guess, for a lack of knowledge, not understanding, we you grow up and you would hear the older generation say it is not good to owe anyone, right? The thing about that is it you really need to understand how money works in the world of finance. Now, credit in the in a layman terms, credit is really the money that you borrow from a financial institution. So the money that you borrow from a financial institution, it is really is what we refer to as credit. To go even further, it may not be just money. We can say that credit is created when one party borrows or receives the resources from another person, which will be the lender. That means that you can receive non monetary resources, like you can receive services. If you are into, say, events and you're putting on, say, if it's a Christmas show, you don't require money, but you will need the services of somebody to put up the lights. You need somebody to put up the stage. You would need security. So what credit does, credit allows you to obtain these services or obtain these goods without immediate payment. So that is what credit is. So credit is created when one party or the borrower receives the resources of another without immediate payment. Debt, however, listen carefully, debt, however, is simply the obligation that you now have. So credit more so in a very specific finance sense is the vehicle that you use to access, right, that good or service. Having access that good or service, that is what you now owe, is your obligation to the establishment. And it will include, what you borrow. If it's money, include what you borrow, which is the principal, and usually there will be terms associated to terms and conditions associated to the borrowing.
Right. And this is where we get into things like the interest rates and the payment terms and so forth.
Correct.
Yeah. So what you say, I mean, based upon what you said in the beginning, is debt and credit bad? Are these bad things? Would you like me to ask that again, Richard?
Sure, yeah, you can ask me again.
Yes. Is debt and credit, are these bad things in and of themselves?
No, not at all. Not at all. What is fundamental in any borrowing situation is the use of the cash or the use of what you're borrowing. So let me run it again. What is fundamental to understand is the use for which you are borrowing. For example,
Mhm.
there are different types of credit, right? You have, revolving line. You can have installment or fixed loans, right? But it really matters what you using that money for. So, for example, um, a company may borrow money, right, to build you. An individual might borrow money to build their company, to start their own business, right? And they do that by purchasing assets, and they purchase assets in order to provide a particular good or service for which they will be paid. So that activity actually helps to increase their financial position. So in a situation like that, if you are borrowing to increase your financial position, then it's always a good thing. Another reason why an individual may decide to borrow is because borrowing allows you to free up your cash flow. So if it is, for example, I want to start a grocery. It might cost me $50,000 to start that grocery, and I would need to buy, stock, inventory. I would need to buy machinery. You know, I would need to buy like equipment, office equipment, and furniture to start the business. It wouldn't be and a good idea, because it's a risk, because of the risk involved in business. It would not be make good sense to take money that you've saved, right, to put in all your money, all your savings, your pension, whatever it is, to achieve that. So this is the role that, a financial institution will come in or play and help you attaining your dreams, whereby you will be able to borrow some of the borrow the funds that is required based on your ability to qualify for credit, and repay at a later date. So what will happen is that you will still be able to remain with your savings. So it helps protect your savings.
And we do have an offline question submission at this time, Richard. And the
Yeah.
question is, can you share tips to improve chances of accessing credit from the bank?
Oh, sure. So I'm glad that question was asked. So the question was asked that can I share some tips in terms of accessing credit? So one of the other reasons why credit is important, because it helps you to establish a relationship and a history, a profile with the financial institution. Because remember, a financial institution is going to lend you money, but they need to know and understand your ability to repay that loan or that obligation. So if it is that you started off with, say, a small debt, let's say you would have borrowed some money to finance your education, right? Um, having done that, they will have a track record of how you're able to repay. Some of the ways that you can access finance from a financial institution is establishing a credit history. The second thing that you need to do is try to limit the number of loans or borrowings that you are doing and the purpose for which you're borrowing. And when I say that is, some people borrow way above their ability to repay. So, say for example, if your earnings is like say about $10,000 a month, you tend in the bank we tend to advise that you should not be borrowing more than 40%, more than $4,000 then, right? So if you are borrowing from the bank, and then you're borrowing from a friend, and you're borrowing from the neighbor, and then you're borrowing from a credit union and all over, what will happen is that you would not be able to be you will not really qualify as credit worthy in the eyes of a financial institutions, because you have too many obligations. So you want to limit that as much as possible. And another thing that you will want to do is limit too much any unnecessary consumer debt. I mean, like credit card debt, because these things could sometimes end you into problems if you don't have the ability to manage it.
Yes, thank you very much, Richard. The issue of, I take it, we're talking there about your debt service ratio.
Yes.
Yes. I see we have a question coming in from a Kyle Blackman. What about using a credit card as a young person, whereby you can attain different services, shop online? What is your advice on credit card, and where does it fall in this whole concept of debt versus credit?
Yeah. Well, as I say, we were talking about so credit could fall in terms of their could fall into different category, or debt could fall into different categories. You have secure debt. That is that, and for debt to be secured, it means that you're exchanging something of value to receive that money or that cash. So a mortgage is an example of secure debt. So as a car loan, where the financial institutions will hold or place a charge over that particular property or that particular asset. For the most cases, in most cases, you will find that credit card debt is unsecured debt. And unsecured debt, because it's unsecured, because the institution is not holding um, any collateral, it tends to be very high in where concerns the interest rate, and the interest rate compounds each time that you don't pay on the balance. So the purpose for which you want the credit card is important. And I think I started off speaking about the use. If you're purchasing credit, if you're using a credit card for your business, because we as financial institutions, we issue credit cards if you want to buy stock online, whereby once you purchase that stock, you're going to receive some a good that you can sell to pay down the debt, to repay the debt. That's fine. But if you're using the credit card um, for just your wanton, just the things that you want, you want to buy a pair of shoes, and you just want to dress up nice and go out, then and if it's attached to a lifestyle, then it becomes a problem. And credit card debts, like in in Barbados, could range anywhere between 24 and 26%, as opposed to a secure debt, like if it's a mortgage or if it's a car loan, could be anywhere from 4% to 6%. So the interest rate is the danger there, and it is something, because it's based on your life, because credit cards are unsecured and it's tied to your lifestyle. If you don't have the ability to manage money, and you're not using it for a business, then it becomes very dangerous.
We do have another question submission, and the question says, can you share about what systems banks typically may have in place for low income persons earning below $4,000 per month but need to acquire loans? Would you be able to share any insight into this, please, Richard?
Can you repeat the question one more time?
Sure. The question asks,
Mhm.
can you share insight about what systems the banks may have in place for low income persons earning below $4,000 per month but may need to acquire loans? Do you have any insights that can be shared?
Yeah, it depends on the purpose of the loan. So banks tend to try to assist or facilitate those individuals who, as because of their circumstances, their earning capacity, you know, may be in a lower bracket than others. Sometimes you would find that banks will have like campaigns, depending on the season. Say if it's a Christmas time, we will do these what you will call make it happen loans, whereby we will probably up to 50,000. We would offer the individual these loans to be able to do repairs to the home, or consolidate their, if they have debt in more than one financial institution. These loans are not generally offered throughout the year. Usually the campaign will run in cycles. And then sometimes you will find that the banks will also fees or waive fees to allow an individual to qualify for a particular, for particular loan. But it all depends. It all depends on what the purpose of the loan is for. So if that individual is seeking, a loan for their home or for like education, you will find that the banks or financial institutions tend to be more amenable to try and see how they can finance and assist. Also, what you have as well is, when we speak about loans, there are two types. There can be two types of loan. You can have an amortizing loan, or you can have a non-amortizing loan. Um, you can have loans that are fixed rate, and you can have loans that are variable interest rate. What banks try to do sometimes, depending on the purpose, you can have an interest-only loan whereby during the, like, if you want to study, for example, you would just be repaying the interest on the loan, servicing the interest until you completed the study, get a job, so it can be repaid. So there are different techniques and different ways that can be achieved.
Is there a lot of flexibility there, Richard? I mean, is this something when you go to the bank with this knowledge that you can actually say, listen, this is the kind of loan that I want? Are those options available?
Are the options available? Well, it depends. It will differ from bank to bank. um what it would usually be an area of consumer lending. I'm more in the corporate side of the lending, but I am very aware that we would do these campaigns from time to time. So what a person should usually do is, you know contact the financial institution, whether it be the bank, whether it be the credit union, and try and find out when these campaigns are going to be available, because they run annually every year. So if it is that you want to get a specific amount of funds for a particular purpose, it may make sense that you have to contact the financial institution to find out when these campaigns are going to be held.
Okay, I see. I see we have a question coming in from Simon Nickham. If I have a consistent monthly savings pattern with the bank, will this be favorable when I try to access a loan?
Um, I would say yes, if you have a savings pattern. But what really is important is what I think the bottom line here is not so much your pattern, is not how much you save, but is how much you spend. Because that there must be a relationship between what you spend and what you save. So you can find an individual. So I want to be very, technical when answering that question. You can save all of your salary, but you can spend more than your salary. So the bank wants to know what are your obligations, because if a bank is advancing you a facility, a credit facility, they are now becoming, they are now standing in line to be paid. So if it is, for example, when you come to the bank and you owe five other institutions, and the sums that you owe is are in excess of what you would need to settle your monthly obligations. Everyone has monthly obligations. You may have, bills to pay. You would have, car loans. You will have, and you may need money just for your living accommodation, etc. The bank would usually calculate that and do that calculation, and it usually falls between, just under 40%. If it's above that, then a financial institution becomes very wary, unless there's someone else who is borrowing with you, and then you have or you have a guarantor or someone else who can come in to assist with that. But to answer the question again, it is really more not so much the saving pattern, but the relationship between your expenses and your income.
Yes, I see we have quite a lot of questions coming in, and I would like to encourage you to direct message CashTalk anytime we have left to cover all the questions that are coming in. And we thank you very much for your questions. But Richard, one of the questions as we wind down, I'd like to find out, given all these peculiarities and all these things that you mentioned about debt and versus credit and
Nuances.
how we can. Sorry.
Go ahead.
Yes, given all these realities, right? Do you think more can be done to help persons prepare? Do you think there's a place for
Um,
credit repair services to help persons understand how they can take advantage of it?
Yeah, definitely, definitely. And I think discussions and conversations like this, what we're having here, is very, very important because the information is so much information out there, it could be a little overwhelming, right? So it's always advisable, it's always suggested to seek out a financial advisor, right? Someone who has the time and the wherewithal and knowledge, that is, to sit down and go through your unique circumstance. The thing about finance is that no two persons are alike. Because we all have different obligations and we all have different situations, and the financial institutions generally try to meet, on average, the need of each individual. But always remember that a bank may not necessarily what your bank may not necessarily the needs that your bank may not necessarily met could be met by another service provider, such as a credit union, right? Sometimes it might make sense to, even if you
Yes.
can, if you're fortunate, to borrow the funds elsewhere than coming to the financial institutions. I know when we were speaking about debt, for example, one another use of the term debt has to do with capital. So for those who are out there who own their own business, right? That refers to money that is borrowed from a financial institution, versus you can raise the capital by issuing shares for that business. The difference is, and the advantage is, if you issue shares, you give up control. And it's also more expensive because that person needs to be compensated for the risk that they're taking investing in your business, right? However, you can go to your financial institution for to raise capital for your business by taking a personal loan and injecting it into your business. Thereby, in doing so, it will be actually cheaper than going to an individual down the street to say, hey, lend me $20,000. I wanna put this into this particular business, right? So a financial advisor, I suggest to
Yes.
sit
Yes.
down and really go through the particular circumstance. Individuals are different from companies, so it all depends on the situation, but definitely yes. I think a lot more could be done, and a lot more discussions like this
Yes.
need to
And
happen.
okay, so Richard, thank you so much for taking the time to share some of these pointers with us. I am sure that individuals would have gleaned quite a lot from what you shared about how to manage the credit and debt. And we understand now that it's not a bad thing. So definitely, I'd like to thank you very much for your time, Richard. And remember, this program is brought to you by CashTalk Credit Repair, a pioneer in credit repair services. And CashTalk is definitely there to help in this regard. So you want to check out CashTalk Credit Repair Services on their YouTube and Facebook pages if you want to find out more. We also thank our producer, LSE Publications. So to keep in the loop at upcoming programs and sessions, do check out Cash Talk Credit Repair on YouTube and Facebook. Like and share, please. So until next time, thank you very much and make sure you mind your business.